Hey, good day, everybody, and welcome back to another edition of Check the Map. I'm Tyler Bannister, joined by Nick Wages and Kirsten Crum of SRG Financial Advisors. Here we are with less than 2 months remaining in 2025. The holidays are fast approaching, and there is no shortage of things for us to talk about. We're going to narrow it down to a couple of focus topics. But briefly, since our last Check the Map nearly a month ago, we're still in the midst of a government shutdown. And markets overall, it has been a little volatile. It hasn't been a straight line, but over the last month, it's been, I would say, relatively muted. U.S. aggregate bond index, so diversified U.S. bonds are up about 1/3% in the last month. We've got gold actually pulling back about 2.7% since our last edition of Check the Map. It's still by far leading the way for the year as far across most asset classes here, but it has pulled back slightly, along with Bitcoin, the fancy digital storage asset in quotes, right? Um, Bitcoin has pulled back as well. The S&P 500, we are slightly positive for the last month, about 1/4%. Dow Jones, Nasdaq 100, both up a little over 1%. Russell 2000, so U.S. small cap stocks are actually pulled back as well, about 2.28%. So no drastic movement overall. When you look at it over a month standpoint for the year, it's still shaping up to be a pretty strong year across most major U.S. stock indices. But like I said, we this whole time since our last check the map, we've still been in a government shutdown. And Kirsten, I think you had a chart to pull up regarding
Yep.
this current shutdown.
Yeah, let me. All right, can y'all see this? Maybe.
Yep.
Here we
Yes.
go. Okay, perfect. So this is just kind of a quick breakdown. Like Tyler mentioned, we are in our longest shutdown. This one currently that we're in started October 1st. So we're looking down this timeline here. Obviously, we start kind of week one, those government workers start to not get paid. Some of those jobs start to get affected. A few things just as time progresses, slowly start to lose funding. Kind of the biggest one more recently has been once we get into this about week four is when low income starts to feel the impact as far as some of those supplemental programs losing funding. And that's kind of been the big topic of discussion right now is some of those might be losing some of those food benefits coming to them. And then obviously, the further that we go, the more pressure there is to end the shutdown. And I just thought this point was interesting that each week of the federal government is shut down, it costs the US economy about $15 billion, roughly 0.2% of GDP. So the pressure is definitely on for them to come to some sort of resolution in ending the government shutdown. But at this point, like you said, it's not like the market has completely tanked by any means, but it's just volatile.
Yeah.
Yeah.
We've emphasized too in the past how meaningful it is to create a strong private market with jobs and job growth outside of reliance and dependence on the federal government. And that stat there at the bottom is a really good indication of that. The less dependent we are on the government itself, we're when we're relying upon the government to produce jobs growth, GDP, it's not sustainable. And in cases like this, it of course drastically affects things whenever they're not operating the way that people expect them to. So pretty unfortunate. Hopefully some level can win out and we can come to some kind of a deal soon.
And Kirsten, you brought up a good point a few weeks ago when you showed that chart. The majority of the time, the following 12 months after a government shutdown, most of the years, the stock market has done well, historically speaking. So,
Mhm.
the human side of the government shutdown right now is the worst part between as far as all the government employees who aren't receiving paychecks, one, and then when these benefits have run out for SNAP and food stamps, it's going to cause real life heartache and struggles and have tough implications. One positive thing is as the day we're recording this check the map, the private payroll data came out for October. and
Mhm.
private payrolls rose 42,000 by 42,000 in October, which was stronger than expected. So, there's no way to definitively say this, but hopefully some of the our reliance on the government jobs maybe is subsiding, because there's no way to get around how painful this is short term. The hope would be that people are able to find really solid job opportunities, whether they are unemployed now or just on furlough, where they're maybe not as dependent upon the federal government going forward in the first place. So the shutdown doesn't automatically mean our economy suffers, but it's crazy that 15 billion is 0.2%, right? That's quite a stat. So it's definitely going to have some kind of weight, and really the timing of this is tough. We're basically 3 weeks from Thanksgiving, and so uh, just people's normal, I mean, family traditions and routines and things like that, which are really an important part of life.
Yep.
That it's super disruptive. So hopefully our prideful politicians can come together and find a solution in the short term. And one thing that we're also I think let's talk about open enrollment for a second. We're in the middle of open enrollment for both Medicare and healthcare.gov, aka Obamacare. Medicare kicked off October 15th. The healthcare.gov ACA plans kicked off November 1st. And one sticking point, talking point of this government shutdown has been the additional advanced tax credits to help offset premium costs within Obamacare ACA plans. And you can technically enroll in those plans right now, but we don't know if those additional enhanced tax credits will be available or not, because it's as of right now they won't be. They're set to drop off unless they're included in this government reopening. And let me see if I can pull this example up, just so you guys can see what that real life impact looks like. Uh, Bear with me. Can you see that screen?
Hmm.
Mhm.
Okay. So right now I'm actually, on the healthcare.gov website looking at 2026 plans, and we're pretending that we're looking for a 60-year-old husband, a 59-year-old wife. So we retired successfully before age 65. And if there's different ways to approach healthcare for this stage of life, but if the solution is an insurance plan through Obamacare, through the ACA, this is what it looks like for 2026. So these two ages, I'm pretending that the gross income for this household is 96,000. Okay, so 8,000 a month. Now this is an after-tax take-home. When you enter in your income for this, you have to put your true gross income, and that includes interest income on savings accounts. It includes dividends, capital gains. You have to factor in anything that shows up as a taxable income event on your 1040. So 96,000 might seem like a lot in some scenarios, but if we factor in all those other pieces that you might not think of as income, it's not unreasonable. Now, I haven't scrolled down yet because the sticker shock might blow you away. So 96,000 gross income, 60-year-old husband, 59-year-old wife. And this is in Columbia, Missouri, which where you live also dictates things. They don't qualify for any tax credits at this point. The cheapest The cheapest bronze level plan is $2,199.64 a month for the two of them.
Where you pay nearly everything out of pocket until you reach a $21,000 max.
Right. Deductible and out-of-pocket maximum 21,200. So you're paying 2,200 a month for the ability to go spend 21,200 on top of that 2,200 a month. And again, this is the cheapest possible plan. If we filter this just to see, hey, what if I want to get to that gold level? What's that look like? Let's apply that filter. Again, this is the healthcare.gov. This is live. Um, to get to the cheapest gold plan would be 2,750.80 a month with a $3,000 deductible. Out of pocket maximum still 17,600. So Um, it's tough right now, and so this is this affects entrepreneurs, small business owners,
Mhm.
families of all ages, retirees who are pre 65 age wise. So this is not a trivial thing, and this is one piece the government shutdown is still leaving people in limbo, saying, "Do I go ahead and enroll at these higher costs? Is this going to get resolved by the end of open enrollment?" And if we go back to the homepage here, you have to enroll by December 15th for coverage to kick off January 1st. So we've got a little over a month at this point for people to enroll, just to make sure they have health insurance. It's a tricky thing, and even on the on the Medicare side, um, we still have they haven't announced the Part B. Now, it's not like people have options. Part B premium will be what it is, but it's going to be a significant amount. So there's definitely some planning questions going on into to the next year at
And
this
this
point.
and this is really one of the reasons why we so heavily emphasize being less dependent upon a massive government that's spending way more than they should, operating at a huge deficit every year and a $37 trillion debt level, is that when people do get reliant and dependent upon that level of spending from the government for things like health insurance, and then they face the tough questions of, oh, well, if we're going to tackle this debt or even this deficit, just try to reduce it some, what's on the table in order for us to accomplish that? Well, it's got to be higher taxes or it's got to be reduced spending. And reduced spending comes in the form of taking away things that people have gotten used to receiving and dependent upon. So,
And we
and
just
the
cut we just cut taxes. I mean, effectively,
right,
we kept taxes low. That was the main thing. We kept them low with the One Big
right.
Beautiful Bill Act, and we had some additional cuts even at the
Hmm.
household level. So
Yeah,
yeah, the only other option at that point is reduce expenditures,
exactly.
uh,
Yep. Yeah,
which will
which is
be
why this is such a point of contention because it's super impactful to a lot of our clients even. It's not a trivial matter. Um, Unfortunately, we're in a situation where really any adjustment to the spending on something like this is going to very significantly impact a lot of the people even that we work with. So,
yeah. I mean, this it's I don't know if it's going to reload this for me, but let's just say I take away that filter. I mean, if I said this household had a $96,000 gross income. And that would be including, all those other ancillary things like interest on bank accounts or CDs or dividends. Let's just pretend, because that would be 8,000 a month gross. Let's pretend, for the sake of the argument, that they're getting 7,500 a month in take home after taxes. This is almost a third of their income would go to having health insurance. So
mhm,
there's two angles to look at. At its core, the question is, how can this be the best solution? Where, I mean, when you get to that level,
it's
you're
probably
that's
not the
what
best solution.
no, but think about it this way. You're talking about a third of the income. That's what a mortgage underwriter looks at for debt to income ratios to qualify for a home loan. So let's just pretend this person still has a mortgage and they have to pay for this health insurance. Two-thirds of their income is probably going to their house payment and health insurance. So again, there's just from a planning perspective, there are different ways to approach this that might be feasible for some households. Like this isn't the only option, but the bottom line is this system in and of itself, whether there's because the advanced tax credits are government subsidies that
Mhm.
are going to the insurance company to lower our cost at the household level. So eh, there's a lot that needs to be done, and the government shut down and can't do any of it to try to resolve these problems in the short term. So
Yeah.
it's
Well,
definitely frustrating.
this is also, although it is really impactful to adjust something like this going forward, one of the reasons why we've seen inflation the way that it is because of the government spending on things like this. When they are producing that much in advanced tax credits to pay the insurance companies, there's nothing really stopping the insurance companies or health providers from raising their costs because they know they're
Right.
getting their money from something. It's going to probably come
Yeah.
from the federal government or insurance companies. So those costs go up, people pay more money, and that's why inflation is a very real concern and planning consideration right now
Yeah.
too.
The similarities between the health insurance scenario and higher education costs, college, university,
Yeah.
are very, very, very similar because of that huge influx of federal government spending. So,
Yeah.
all right, well, yeah, that's fun stuff. Let's talk about inflation now, right? So
Yeah.
we'll dive into that. Nick,
Yeah.
you said you had.
Yeah, we did have, I mean, I wouldn't necessarily consider it cooling. We saw the annualized rate come in at 3% for October year over year. It was actually moving in the right direction. We had some lower months from September and October of last year fall off of the report. We continue to emphasize, though, within the inflation report, what's actually impacting the clients and households that we work with. What kind of pains are they really experiencing when it comes to budgeting and the things that they spend their money on? So, kind of an interesting interactive chart on the Bureau of Labor and Statistics website. Let me grab this. All right, so here's the red line going back 20 years, the levels of inflation that we have experienced in the last 2 decades. Obviously, you can see in 22, that's when we really peaked out. We've been on a somewhat downward trajectory since then. We've got two V-shaped bounces here where we were moving in the wrong direction after kind of reaching a trough, so to speak. So we bottomed out at 2.3% year over year inflation back in April. Remember, the Fed is consistently looking for 2%. We are having a really, really difficult time getting to that point. In fact, what's funny is they've looked at 2% as risks being balanced when you compare that with the unemployment rate being about where it is right now at 4.3%. We never have gotten to 2%, yet the Fed has lowered rates twice in the last roughly 30 days. So interesting to see which reports and data they're looking at to produce those specific results. And a lot of people that went completely under the radar. Like the government shutdown has been really prominent. The tariffs, especially the tariff situation with China, those have been front page headlines. The Fed lowering interest rates, almost back page news at this point. Unless you get online and check your savings account rate, because banks do adjust their high yield savings, their money market, their savings account rates based on what the Fed does with the federal funds rate. So that's where at a real household level, you may have experienced the Fed lowering rates. It has lowered mortgage rates. Mortgage rates have been a little more competitive, although last week's drop of the rate didn't necessarily produce the result in the mortgage-backed securities market that a lot of mortgage professionals were looking for. So when we look at this inflation report, though, and we see 3% year over year, Tyler, did you mention the Social Security increase was 2.8%?
I hadn't yet, no.
Okay, so they announced that the cost of living adjustment for Social Security recipients will be 2.8%. The concerning part of that, obviously, is the fact that that's not even technically keeping up with real inflation, especially when you consider the fact, like you mentioned, Part B premiums are also inflation adjusted and are also going to be going up. They haven't announced that particular change yet, but we're already losing to overall inflation, and the increase to Social Security recipients is probably going to be largely offset by Medicare Part B premium adjustments. And other, maybe even supplemental plan adjustments too. So, not necessarily.
Yeah, right now, Part B is projected to go up over $20, right, on a monthly basis, which as a percentage is well into double digits, which is far more than 2.8 and far more than 3%. So, from a planning perspective, if you're at home and you're already working with us, and we've already factored in inflation to your game plan, but we'll probably at our next quarterly planning meeting or semi-annual planning meeting, we'll probably ask you, how is your income level? Is it still sufficient? What does it look like on an actual practical month-to-month basis? And if you're not working with us, or there's people that if you are, and you know people who are frustrated or concerned about inflation and their income not keeping up, we'd be happy to visit with them. If they have questions, feel free to have them reach out on our website over the phone, and we can talk through those at any point. Because this isn't going away. You can see it from this chart. Inflation's not going to go away. The only time it dropped below zero, which we don't want deflation, was at the tail end of a recession. So we hope that doesn't happen again.
Yeah, the worst economic experience we've seen in the last generation. So, so one of the reasons why so I used to have clients tell me when Social Security, they'd get their notification of their bump, they'd say, "Oh, that's an extra meal out per month." Well, that's actually not even true, because that now you're going to pay that to Part B premiums. Also, let's take a look at food away from home, right? So food away from home is actually above the inflation curve at 3.7% most recently. It has come down from its peak, like most things, but still hovering over what actual overall inflation has been. So that's not necessarily a promising component. If you're somebody who says, yeah, we got to eat at home, it's too expensive to eat out, I agree with you. But we also saw this bottom out last year, and now we're actually a little bit more on the rise as far as food at home. We talked about more specifics with food, like beef and healthy eating versus the alternatives that are ultra processed, which do tend to experience less inflation because they're more mass manufactured. Well, eating healthy at home is getting more expensive. Even just eating food in general at home is still actually pretty close to in line with overall inflation at 2.7% instead of 3. One of the encouraging components of the report is, and this has been one of the main drivers of inflation for the last several years, has been housing rents and shelter. So this is actually moving in the right direction finally. In fact, last month, there was only a 0.1 increase for the month in housing rents, which is the lowest inflation reading since 2021. So we're moving in the right direction on that front. We still have a lot of work to do. We're still talking about something that's very unaffordable, like living, especially if you're getting out of college, getting your first job, renting versus buying. It's a challenge to find something that's affordable. It already is a challenge, and we're not talking about the costs going down. We're talking about the costs. Oh, they only went up 0.1%. So it's still a real concern, and year over year, it's still up 3.6%.
Yeah.
And then we also bottomed out with medical care services back in 23, and you can see this is on the rise again. A concerning part about being reliant upon the government, shelling out subsidies and tax credits to pay for things like insurance and to pay providers whenever care is needed, is that inflation is always experienced at a very high and real level in areas like that and education. So there are some components of this report that, even though you may see headlines that say inflation cooler than expected, the reality is that that isn't necessarily being experienced at the household level. People are still paying, way more for things than what they're used to pay, for what they're used to paying. And it's also a very real reason why we build out ideal game plans, and included in those are contingency plans for increasing income every single year to keep pace with inflation, to make sure that a static $5,000 a month for the rest of your life doesn't erode your buying power over time, because it's worth a lot less in 5 or 10 years from now than it is today. So one of the reasons why we do meet with our clients on a regular basis, as much as quarterly, is to make sure that income is in line with real income budgeted needs. And also to make sure that we have effective plans, and even adjust those effective plans for providing the income that's needed at the household level to keep pace with things like inflation on food and medical care and shelter. So
Yeah, thanks for sharing.
Yeah,
It's good. So go ahead, Kirsten. Sorry.
no, just kind of a few closing points on inflation. I had a few comments from the minutes because, as we know, like you said, the inflation reports have been kind of on the back cover, so we've been missing out on some of these big headlines as far as what might come out of the Fed's mouth as far as speaking about inflation. One interesting kind of comment is speaking about the data limitations from the government shutdown, because obviously we haven't had as many reports. Nick, you mentioned what data are they going off of? We haven't hit that 2% mark, especially, and we still have rate cuts coming. And their only point to that is that they are driving in the fog, and their plan is to slow down. So that's the idea, and that's where we're going with. And then just going off of that Powell reiterated a further reduction in policy in December would not a foregone conclusion, if anything, far from it. So trying to reiterate he is driving through the fog and does not know what is coming in the future. Again, goes back to our point, not relying on anything from the government. We're not relying on what decisions they may make, and especially during this time when they have some limited information when they're making these decisions.
And actually, one of the very few logical explanations that I've seen for the Fed's policy in the recent months is it actually comes from the fact that we are shelling out less money at the government level. And because of that, consequently, we have seen a slowing in the growth rate of the M2 money supply. Well, if the M2 money supply doesn't increase as rapidly as it has in the past, then people don't have as much money to spend on something. So the reality of that is that if there are inflation on necessary and essential items and people are spending their money on those higher prices, they consequently have less money left over to pay for other things, which could lead to slower inflation on other categories and maybe non-essential. So the slowing of the M2 money supply growth rate over the last couple of years is actually probably the most logical and prominent case for lowering the Fed lowering rates and hoping to combat what we've seen as far as maybe a slowing job market, at least at the federal level.
Yeah. Kirsten, did you happen to have upcoming dates that we'll keep an eye
I
on? Again,
sure,
contingent
I sure
upon
do.
government reports coming out.
Yep, yep. All right, can we see this?
Yep.
All right. So, yeah, like Tyler mentioned, we have the economic calendar here for November. However, very contingent on some of these things, whether or not they get published due to the shutdown. Let's see, today's the 5th. Honestly, this ADP employment numbers, those are going to be the private sector numbers. Those are going to be the reports that we're able to look at rather than some of the more federal-based employment reports coming out. So today we also have the ISM non-manufacturing index and mortgage applications. Tomorrow we have weekly jobless claims. Friday, employment report. Consumer sentiment reports should still be coming out. I know I saw some of them still, but some of those bigger ones, like looking into next week, the CPI and PPIs could kind of vary dependent on the shutdown. And then, of course, we also have Veterans Day next Tuesday. It's kind of our next couple weeks ahead.
Thank you for that. I appreciate it. And everybody watching or listening at home, thank you for your time. We appreciate you being here with us, and hopefully you found this informational. As I mentioned earlier, there's a lot going on. It's led to a lot of questions as we've been having meetings with both existing clients and new households that we've been introduced to. So if you have people in your life that are asking these questions, have some concerns, would like to really know where they're at from a financial planning standpoint, we'd be happy to visit with them. They can reach out to us at 573-302-7212 or through our website. You can send emails and even schedule appointments there at srgfinancialadvisors.com. We will talk to you again soon, and we appreciate your time. Thank you.